So what is the total out of VAT? So we have that as 33,840. Somebody just to confirm. Is that perfectly okay? Is everything okay? So somebody gets a new one. Which one is which? Which is which? Now it says 28 to 40. So you have 28 to 40. Thank you. I want to talk about a concept on budget altogether. Because again, you're going to encounter a number of things on budget altogether. You see, there's basically different approaches altogether. Then you find different lecturers who give this to this altogether. We say that the different approaches that different lecturers will give to the budget altogether. Are you getting me? Respond with a yes if you're there. So you'll find that there will definitely be different approaches altogether. Let's say, for example, you have a scenario where you have a VAT account. Some lecturers will say, because it's something that you basically claim later. So once you get the VAT payable, or refundable is when the less what's called the bad debt, the VAT on bad debt, the VAT on bad debt. Are we together? I'm saying when you get some approaches altogether, some people say that for the bad debt, you first of all get the VAT payable or refundable is when you less it altogether. So for those two approaches altogether, they will still be given. Are we together? So if you see, for example, somebody will say, let's say you have scenarios where you don't have exempt altogether. And then somebody says, if first of all gets the VAT payable or refundable is when it less the VAT on bad debt, this will still be an entry. There will be nothing wrong. Both of those approaches will still be given to get a team. So when you see somebody doing this, let's say you have a VAT account, somebody is not going to maybe put the VAT as a less or as a positive on the input side, but when it gets the VAT payable, it will simply less what you call the VAT on bad debts altogether. That those two approaches will still be given. Those entries will still be given. Is that noted? We respond with this. Is that noted? Yes, because you encounter, as you revise with majority of people, you'll find some lecturers do it. They'll say VAT payable is when they less the bad debt at the last item. So still will be given altogether. Still, that will be given. So then we restrict. We say that in this question, we restrict altogether. So I want these figures. I hope you have these figures. I want us to get the taxable supply. I want us to get standard rate. Let's get this figure: standard rate sales. So what is the total for the standard rate sales? What is the total for the standard rate sales? So if you look at the standard rate sales, we have 180, 960. We have another standard rate sales, 64. We have 64. We have 64, 960. Are we together? But then you need to less this credit note 20, 880, and then we need to less 2030. So what is the standard rate after adjustment? What is the standard rate sales? So these are the sales. This is the credit note received. This is the budget. So on the adjustment, what is the credit? What is the standard rate sales? Get for me that. Get for me that. So when you deduct, that's what we have. So we have 207, 740. So we have 207. So that is 204, 740. So we have 20474 740. But remember, is this figure inclusive of VAT or exclusive of VAT? Is this figure inclusive of VAT or exclusive? So it's inclusive of VAT. Remember, when you're doing the restriction, the figure, should it be exclusive or exclusive when you're restricting? It should be exclusive. It should be exclusive. So exclusive would be, say, 100 over 116 times a figure of 204, 740. So what is that figure? Exclusive of VAT. The standard rate exclusive of VAT. So that should be, you have a figure of 176, 500. Can we confirm that that figure we have it, all of us? Can you confirm that we have that figure, all of us? I hope we're together. So then I proceed to the zero rated, the total for the zero rated. So if you look at zero rated, what is the total? So we have export to Egypt, and then we have what's called the export to Malawi. So for the zero rated, we have a figure of 480, a figure of 480 plus 240 plus 240. So what is the total for the zero rated? So give me the total for the zero rated. So the figure is 720. Then now we have the exempt, 720. So then we have the exempt. So the first exempt that we have, that should be 170, 170. We have 170, 170, 170 plus 250, 170 plus 250. So what is the total exempt? So 170 and 250. So what is the total exempt? So give me for the figure. That should be a figure of 420. So a figure of 420. So these are taxable supplies. Get for me the taxable supplies. Taxable supplies. Taxable supplies. So what is the taxable supply? So that is 176 plus, this is the standard rate, plus zero rate. What is the taxable supply? What is the taxable supply? Are we having that? That should be 896, 500. Then you can get for me total supply. That's, you add this and this. So get for me the total supply, total supplies. So what is the total supply? What is the total supply? Total supplies now. So add that figure to 420. What is the total supplies? Total supply. Total supply. Somebody to give me the total supply. So that's 1316, 500. 1316, 500. So then we restrict so that we get the deductible input VAT. So we get the deductible DIT, deductible input VAT. So that's the taxable supply, which is 896, 500, over what we call the 1316, 500 times the total input VAT, which is a figure of 123, 360. So what is the deductible input VAT? Give me the deductible input VAT. So give me the deductible input VAT. So what do you have? We have a figure of 80, 5005. Perfect. So then we get the VAT payable, payable, so what we call refundable. So we have what's called output VAT, which is 28 to 40 minus 85005. So is it a refund or is it a refund? Is it a refund or a refund or a payable? A refund of? What is the figure for the refund? Get for me the figure for the refund. If I say refund, I don't need to write it negative. What is the refund? The refund. So we have 5,765. So that should be the refund. Together, team. If we are together, we respond with this. Perfect, Sami Keys. What about the others? Aaron, are we together? Thank you, Zipporah. Thank you, Aaron. Marina, are we together? Harriet, are we together? Harriet, are we together? Perfect, if you're together. Thank you, Naomi. Are we together? So I think most of the question, if you look at what I want to now start doing with you, I'm going to give you extra questions based on those semesters the questions that we've done in the previous semester altogether. So I'm going to add you extra questions altogether on for the partnership and for those particular areas that we've done altogether. There are more questions that we've done. So I'm supposed to share those videos. Joy, make sure that those videos are shared by Tuesday of next week. Partnership, I will do, I should give extra videos that I do, extra questions that have been done. I should also be able to give VAT. There are also extra questions, about 5-6 questions that are not here, but we have done it together. I think I've done all those years. December, I've done April, I've done August. So those, they should be shared, Joy. I should be sharing topically. So we can start with VAT so that we don't have sharing so many videos. So we can start with partnership or VAT. You can choose one, what you need us to share. But remember, this is a compulsory question. So I want us to move to the next thing, that is taxation of cross-border activities. I want to start with taxation of cross-border activities. Taxation of what we call cross-border, taxation of what we call of the cross-border activities. Taxation of what we call the cross-border activities. Do you have the handout on taxation of cross-border activities? If we do not have, then you let Malusha. Do you have the handout on taxation of cross-border activities? Taxation of cross-border activities. Do you have the handout on cross-border activities? That's what I want to start on. I just introduce is when you come back. Do you have that handout? Taxation of the cross-border activities. Is that handout provided? Kindly respond with a yes if that handout is there. Joy, is the handout there? Taxation of the cross-border activities. So let me share that handout immediately and we introduce it together. And then we introduce it before we go for a break. We introduce it. Two minutes. I should be able to have that handout. Kindly confirm that that handout is there. Shared already. Shared already. Shared already. Kindly confirm that you have it. So I want to start by just providing a background information on the number of things that we basically discussed on the intermediate for those that are basically taught. When you talk about taxation of resident and non-resident, we basically say that for resident, if you remember this concept that we discussed, if you remember that concept, just a minute, my pens. If you're very keen on what you were saying, particularly on the intermediate, we say that for a resident person, that is the difference between taxation of a resident and non-resident altogether. So one of the concepts we said that I want to tie to what I want to do, we say that for a resident person, employment income is taxed from wherever hand. Did you say such a concept? Did you talk about that? Did you talk about that? Did you talk about that? That for a resident person, employment income is basically taxed from wherever hand. We talked about that. But you also talked about for business income, this is for a resident person. If you have a business that basically is operated partly in Kenya and partly outside Kenya, we say that the total income is basically taxed in Kenya. However, I'm very sure that not many people ask me question, or maybe I explain how it together. So one of the questions that basically arise in our mind, if we say like that, for example, I was in UK and I'm a resident person, I'm earning an income and I'm already taxed in UK and I'm being taxed in Kenya. Does it amount to double taxation? Does it amount to double taxation? That is the question I think you should have asked me altogether. But when it comes to cross-border activities altogether, especially this one is basically synonymous. Number one, those that are synonymous to this taxation of cross-border activities, we have what called citizens that are working abroad altogether. We have the citizens working abroad. We have expatriate employees working in the country. How do we go about taxation? We have professionals offering services abroad. How do we go about it altogether? We have what we call the sportsmen and women earning income from abroad. And we have businesses that are partly carried in Kenya and partly outside Kenya. Those are categories of individuals that are basically affected by taxation of cross-border activity. Together, we respond to this. Those are categories of individuals that are affected by taxation of cross-border activity. So in this, we're going to discuss how do we go about taxation altogether. And we're going to talk about a number of concepts. How do we go about it altogether? But again, how do we go about taxation of such individuals? That is what precisely we're going to discuss in the taxation of cross-border activity. We are going to talk about agreements altogether. Remember, when it comes to these different countries, there's what you call there's also what you call agreement, taxation agreements that are basically that these countries normally have altogether. For example, you can have maybe a country X and A agreeing that if our citizens are taxed in Kenya, then we are not going to tax them back at home. If Kenyan citizens are taxed back in their home, back in that other country, then at home, they are not going to be taxed altogether. But again, the second concept, we call it the double taxation relief. If you compare the tax that has been paid outside the country and the tax that is paid in the country, we deduct the law. But that's just that was just simply piecemeal. So we start with taxation of cross-border activities. So when you talk about cross-border activities, we're saying that income generating activity, we call them income generating activity. Income generating, we call it generating activities. We call it carried out by citizens of Kenya, carried out by citizens of Kenya, carried out, and we say by citizens of Kenya, carried out by the citizens of Kenya. We say that carried out by citizens of Kenya, or none, or in other countries, in other countries, and then you say or none, what you call the none, or what you call the non-citizens in Kenya, non-citizens in Kenya. That is what's called the cross-border income generating activities. The citizens of Kenya are which are carried out by citizens of Kenya in other countries or non-citizens in Kenya. So terms used in cross-border activities. We move to the terms. Terms we say used in what's called the cross-border activities. Terms that are basically used in cross-border activities. Terms that we say are used in cross-border activity. I want to start with the first term. We call it trading with a country. Trading with a country. So the first time we call it trading. We call it trading with what you call a country. So when I say trading with a country, what does it mean? When you say trading with a country, what does it mean? Trading with a country. So we say citizens of a country, citizens of a country, and the one is enters into, we call it enters into, citizens of a country enters into business with citizens of another country. Enter into business with citizens of another country. That is what's called trading with a country. Together, team, we call it trading with the country. Is that understood? Naomi, is that understood? Respond to the yes if that is understood. So then we'll proceed to the next concept to call it trading in a country. When you say trading in a country, trading in a country, what do you call a country? Trading in a country. Trading in a country. So now for this one, there's something that I've not mentioned. So when you talk about trading with another country, that's subject to what we call double taxation. Income generated is subjected. We need to understand that income for this income generated, we say is subjected to what? To double taxation. So the income that is basically generated is basically subjected to double taxation. That is trading with a country. Together now, I've added that. Zipporah, we together. We call it income that is generated on the first item. We say that, Marcy, you have what I'm asking for the second, but I went back to the first statement that I made. Is that understood, Tim? The first statement that I made. I hope that is understood. Yes, but Marcy asked for the second. Marcy has what we need within the borders. So together, citizens of a country carrying out business transaction, citizens of a country, citizen of a country carrying out business transactions, and we call it within the borders of a country, within what we call the borders of what we call a country. So that is within a country. As Marcy says, the word is just within a country. So if you're trading within a country, do you have the concept of double taxation? So we understand that is not subjected to double taxation, not subjected to what? Subjected to what's called to double taxation, not subjected to what we call double taxation. So if you're trading within the country, then that is not subjected to double taxation. So that concept is what's called the double taxation. We talk about double taxation. So when you talk about the double taxation now, we're just saying that is where income generated is subjected. Income that is generated is subjected to different forms of tax in different countries. Income generated is subjected to different forms of tax, to different forms of what we call tax in what we call in different countries. So the incomes that is basically generated, we say is subjected to different forms of tax, and we say in different countries. Is that okay on the double taxation? Then we talk about double taxation relief agreement. The third concept, the fourth concept, we call it the double taxation relief agreement. Double taxation relief agreement. Double taxation relief agreement. Are we together? A double taxation relief agreement. And this is the concept that will tie our calculations based on questions that pertain to double tax, pertaining to cross-border activities. We have those agreements. What is one of the agreements that we have? We have the credit method, we have the exemption method, but you say that an agreement between two or more countries, we call it an agreement. We call it an agreement. We say between what we call two or more countries, agreements between two or more countries. We call it the agreement between two or more countries to grant double taxation relief, to grant what we call double taxation relief, an agreement between two or more countries to basically grant what we call double taxation relief to their citizens, to what we call to their citizens, we say affected by what's called by double, affected by what's called the double taxation, affected by double taxation. Is that understood? I hope that is understood. Are we together? I hope that is understood. So individuals affected by double taxation, then I give you a break. Individuals, we talk about individuals. Individuals, we say affected by what's called by double taxation. Individuals affected by double taxation. Individuals affected about four, five individuals affected by double taxation. One, citizens of a country working abroad. Citizens of what we call of a country. We call it working abroad. Citizens of a country that we say work abroad. Then we have the second, expatriate employees, expatriate employees working, you just say working in Kenya or in a country, working in Kenya, expatriate employees that work in a country. No, we'll talk about those agreements, how those agreements work. Sami kids, I will talk about those agreements, how they work. Are we together? How they work. So don't worry. So working in Kenya or in a country, just say in a country because it can, in a country. So then we can talk about what's called professional offering services abroad. Professionals, we say offering what's called services abroad. Professionals that basically offer services abroad. Then you can talk about sportsmen and women. Sportsmen and women. Then you say entertainers, entertainers earning income from abroad. Earning incomes from abroad. Incomes from what we call from abroad. Earning incomes from abroad. And entertainers earning incomes from abroad. Then lastly, we'll just talk about business carried out partly in Kenya. Business carried out, we say partly in Kenya, and you say partly outside Kenya, partly outside Kenya. So we can have our break, or you don't need a break. Do you need a break or you don't need a break? Do you need a break or you don't need a break? Do you get our break or we continue? Yes, that's okay. I want to start on what's called the objectives of what they call double taxation agreement. Why do countries basically come up with these double taxation agreements? So that is what we call the objectives of double taxation agreements. So what are the objectives of double taxation agreement? One of it is to basically facilitate investment together. Let's say, for example, to date, for example, I wanted to invest in Tanzania, and I'm told that I'm going to be taxed in Kenya, and at the same time, I'm going to be taxed in Tanzania. Do you think I'm going to invest in Tanzania? Am I going to invest in Tanzania? If I want to invest in Tanzania, then I'm told that I'm going to be taxed in Kenya, I'm going to be taxed in Tanzania, but at the same time, I'm going to be taxed in Kenya. Am I going to invest in Tanzania? I am not going to invest in Tanzania. So one of it is basically to attract what's called investment. The second is to basically attract what we call a skilled manpower. A skilled manpower cannot move, especially when he or she knows that is going to be taxed twice. Are we together? Again, the third, to protect citizens of a country from what we call the double taxation. Then we say that facilitate. If we have this double taxation agreement, facilitate what we call free movement of what we call labor. Facilitate what we call the free movement of labor. And lastly, it encourages citizens of a country to look for jobs abroad. So we talk about objectives. Objectives, we call it objectives of double taxation. Double taxation, we call it agreements. Objectives of what we call the double taxation agreement. Objectives of what we call the double taxation agreement. So objectives of what we call the double taxation agreement. Objectives of the double taxation agreement. So one is to attract, let's say attract investment. Attract investment as a pattern. We know that attract what we call skilled manpower. Attract what we call skilled manpower. Attract what we call skilled manpower. We can also talk about free movement of labor. Facilitate what we call free movement. The word is movement of what we call labor. Facilitate what we call the free movement of labor. Facilitate free movement of labor. And encourage citizens of a country. Encourages what we call citizens of what we call of a country to do what? To look for what we call for jobs abroad. To look for job abroad. Encourage citizens of the country to basically look for job abroad. Then protect citizens of the country. Protect what we call citizens of what we call of a country from what we call from double taxation, from double and college taxation. Citizens of a country from what you call the double taxation. So those are the objectives of double taxation agreements. I hope that is clear. Is that clear? Mercy, I hope that is clear. I hope that is clear. So then we can briefly talk about countries that have double taxation agreements with Kenya. Maybe just three countries. Countries that I would say that have double taxation, and we call it agreement with Kenya. So countries that basically have double taxation agreement with Kenya. So we have the United Kingdom, Germany, Denmark, United Kingdom. We have Germany, Denmark, etc. Denmark, etc. These are but a few countries that basically have such agreements with Kenya. We can also have Sweden, India having such an agreement with Kenya together. So those are countries that basically have agreements with Kenya, double taxation agreements with Kenya. We have Sweden, we have United Kingdom, Germany, Denmark, etc. Are we together? But I want to say that there are conditions that basically that must be met, conditions that should be met in order to qualify for what we call double taxation relief. Conditions to be met, conditions to do what? To be met, to do what? To qualify. We say qualify for what we call double taxation relief. Conditions to conditions to be met in order to qualify for double taxation relief. I want to talk about those conditions to qualify. So in order for one to qualify for what's called the double taxation relief, there are basically about 4 conditions. We say there are about 4 conditions that must definitely be met for an individual basically to qualify for what we call double taxation relief. So tax must have been paid in that country or home country. Tax must have been paid. Number one, in order for you to qualify for relief, tax must have been paid in that other country on income subjected to double taxation. Are we together? So in order for Kenya, for example, in order for us to grant you double taxation relief, tax must have been paid in country X. Are we together? Otherwise, if you do not pay that tax, do you think there's need for relief? There's no need of relief. So as a country, tax must have been paid in another country in order for you to qualify for what you call relief. That's the first condition. Give me a yes if you're together. Give me a yes. Tax must have been paid in another country if Kenya is basically to grant you a double taxation relief. The second condition, we are basically saying that double taxation relief should not exceed tax payable in the home. So this one, as we do questions, and I know you're going to see this thing as we do a question. So the tax that is paid in that other country, if it was country X, and we have Kenya, are we together? In most cases, you'll find the tax that is paid in that other country, you can say, let's say, for example, it's 2 million. You'll find in Kenya is more. In most questions, you'll find in Kenya, if that income is subjected to tax rate in Kenya, you find it's most likely more. Are we together? So the second condition, we're basically saying that the double taxation relief should not exceed tax payable in the home country. You realize that the tax that you paid in that other country, let's say for country X, that tax is normally less than the tax that you're supposed to pay in Kenya. If that income is subjected to Kenyan rate, that tax that you paid is normally less in those questions, if you're very keen. So the tax that is paid in that other country should not exceed the tax that is paid in the home country. That is the second condition. Together, team. That is the second condition. Give me a yes if you're together. Yeah, that should be the second condition. Perfect. So the third condition, in order for one to qualify, there must be a double taxation policy or agreement in that country. There must be double taxation relief policy in that country. It's always obvious. It does not exist in most cases. Yes, you'll not find that scenario together. So that's a rule. You see, you'll not find that scenario. I'm saying, Joy, if you get to those questions, you'll not find that scenario. You'll always find that income, if it's subject to Kenya, it's always a match. Are we together? So you'll not have that scenario. So don't worry about that scenario. Are we together? You'll not have that scenario for questions that you're given. Is that not a joy? But again, if it passes, the logic could be, look up. If it exceeds, logically, what should you do? You should grant the lower as the relief. You should grant the lower. Because if, look up, you should grant the lower. We say that you should grant the lower as relief. That would not be fair for your country. Joy, you see, your country is trying to, as we exercise this double taxation relief, the danger with that is that if the tax in your country is lower, are we together? If the tax in your country is lower, are we together? If the tax in your country is lower, so you'll not find it. Let's just leave it that you'll not find that altogether. So the tax in that particular country must always be lower. Then the third condition, we're saying there must be a double tax policy in the country. We say there must be a double taxation policy or agreement in the country. In order for one to qualify for what we call double taxation relief, there must be a double taxation policy or agreement in the country. Together. Perfect. Then we talk about the last one, the limit for making what a claim for relief. The limit for basically claiming the relief, we say, is usually 6 years. The limit for basically claiming for relief we say is 6 years since tax was paid in that other country in relation to income subjected to double taxation. So they have a limit, and you're saying that the limit for claiming should be 6 years from the time that you paid that tax in that other country. Those are the conditions in order to qualify for what you call double taxation relief. Understood? Do I need to write it? We don't need to write it altogether. So area covered by double taxation agreements. So we proceed now to areas. We don't need to write that. You have the areas. Areas we say covered by what's called the double taxation agreement. Areas covered by double taxation agreement. So areas covered by double taxation agreement. So the first area is persons covered by the agreement. We call it persons. We say persons. We say covered by agreements. Let's say citizens working abroad, persons covered by the agreement, like citizens are working abroad. Then we say taxes covered by the agreement. We'll talk about taxes. We say covered by the agreement. Taxes that are covered by the agreement. We have what's called incomes affected by the agreement. Incomes affected by the agreement. Incomes, we say, affected by what's called by the agreement. Incomes affected by the agreement. Incomes affected by the agreement. That's also an area that is covered by those agreements. Then terminations of agreement, the areas that that should be covered, terminations. We call it terminations of what we call agreements. Terminations of what we call the agreements. Terminations of what you basically call the agreement. Terminations of the agreements. Terminations. We call it the terminations of the agreement. Terminations. We have terminations of the agreement. Termination. Then aspects of determining residency. Aspects of determining what you call residency of what you call of the taxpayer. Are we together? Aspects of basically determining the residency of the taxpayer. So those are areas that are basically covered by double taxation agreement. We give it a yes. We'll give it a yes if areas that are covered by the persons affected. We have taxes covered by the agreement. We respond with a yes if you're together. Joy, are we together? Joy, are we together? If we are together, we respond with yes. Thank you, Joy. Somebody that Harriet, are we together, Harriet? Aaron, are we together? When I get some of my students are very quiet, we must get along to know where you are. I hope everybody's okay. Zipporah, I hope Zipporah, you're in class. Are you okay? Perfect, if everybody's okay. So I want us to go to forms of what we call the double taxation, forms of double taxation relief agreements. Forms of what we call of double taxation relief agreement. Forms of what we call the double taxation relief agreements. So we talk about forms of double taxation relief agreement. So I want to start the two forms. We have unilateral relief, then we have what's called bilateral relief. So we have what we call the forms of double taxation relief agreement. So one, we call it unilateral relief. And then we have bilateral. From the word itself, These are now things that we just discussed, and we close it because we have them in the notes. So when you say unilateral, what does the word unilateral basically mean? When Mwalimu says unilateral, when you say unilateral, what does it basically mean? What does it basically mean? When you say unilateral, not bilateral, unilateral. The word uni, not bi. Bi will be two. Uni means one. Then bi basically means two. Yes, bi will be two. So when you talk about unilateral, this is where government decides to grant relief to its citizens. Are we together? Government decides to grant relief to its citizens working abroad who are subject to double taxation without considering the other country. Are we together? So it's important we say that when you talk about unilateral relief, the government decides to grant relief to its citizens working abroad without coming into agreement with that other country altogether, without considering whether the other country grant their citizen double taxation relief. Are we together? That is unilateral. It is Kenya deciding that for our citizens who are working abroad, we are going to grant without considering whether the other country government grant their citizens working abroad double taxation relief. So that is unilateral. It's simply Kenya deciding that you're going to grant our citizens relief. If they're paying taxes abroad, we are not going to subject them to tax. That is unilateral. Is that at home? Minor? Are we at home? Perfect, minor. Then when you talk about bi now talks about these two countries coming together. So we say we are two or more countries, but precisely when you talk about bi is two. But you can say two or more. Now in terms of tax, bi basically means two. But in terms of tax, we can say two or more governments negotiate and conclude double taxation agreement where citizens working abroad in their countries are granted double taxation relief. So two or more countries, though bi means two. So we can say two countries are agreeing that the countries working abroad will be granted what you call the double taxation relief, will be granted the double taxation relief. Countries come in agreement. We respond to the yes if that is true. So they negotiate. No. We are not saying that they are granted. No, not twice. So it's a policy that, if, let's say, for example, Kenyans are being given, are subjected to double taxation relief, they're not taxed in Kenya. The income, once they're taxed there, the income is not taxed in Kenya. And so Kenyan citizens, again, once they're taxed in the other country, they'll not be taxed in Kenya. Are we together? Once other citizens are together, let's say, for example, country X and Kenya. So country X personnel working in Kenya, they're taxed in Kenya, they will not be taxed in their country. And you say Kenyan citizens working in country X, once they're taxed in country X, they're not taxed in Kenya. That is an agreement. Those two countries coming together for agreement together. Not they're being granted twice. Together, Macharia, respond with a yes if you're together. Perfect. So these methods that we'll talk about constitute the calculation. Are we together? Methods of determining double taxation relief. Methods of determining, we call it determining what's called the double taxation relief. So these methods is what will help us to, is what is going to help us to calculate. So we basically have two methods, exemption and the credit method. So we have one method called exemption method, and then we have what's called the credit method. Are we here, Aaron? Aaron, are we there? Are we there? Perfect. So this one is simple, and this you can ask only definition. So this is the method that we're going to use. Most of the question, we are basically going to use the credit method. So the credit method is what most of the calculation, are we together? we are going to use the credit method. Are we together? We are going to use the credit method. I think we can stop at that point because we may not be able to do those methods, especially exemption is quite easy together. So exemption is quite easy. When you say exemption, we're just saying that if income earned abroad is affected by double taxation, is not subjected to tax in the home country. That is exemption. So when you say exemption, if income earned in other countries is affected by double taxation, you've been taxed in UK, you're not going to be taxed in Kenya. So we call it, once it's taxed on the source country, where income is taxed, where somebody has been taxed from the source country, is not going to be taxed in the home country together. So say affected is not subjected to taxation in the home country as long as it was taxed in the source country. That is exemption. Is that clear, Zipporah? So exemption, we are basically saying that if you're taxed in the source country where the income was generated, we're not going to tax you in the home country, and that is exemption. So exemption, there's no calculation that we're going to use the exemption. However, most of the questions will fall on the credit method. So in our next class, that is on Tuesday, we are going to discuss the procedures. We have about 6 procedures when it comes to credit method. Then we start on those questions. We'll do about 2 or 3 questions. Those are smaller questions. We're able to do 3 questions in 1 hour or 2. We can do 2 or 3 depending on what you need to do. We are able to do 2 or 3. In 1 hour, we can do 2 or 3. Then we will move to the next thing. If you receive an invoice, you will know it has been taxed. If you receive an invoice from, somebody asked, let me ask, if you receive an invoice from abroad, how will you know it's already taxed? How do you know an invoice has already been taxed? How do you know the tax has been paid? You see, the tax policy for countries abroad, for countries abroad, how do they handle most of their taxes for countries abroad? Is it like Kenya where our tax is paid at the end of the month? Most of our taxes are paid at the end of the month or at the end of the year abroad. Let's say, for example, you go abroad. How do they handle their taxes? Most countries in abroad. Tim, even for us, for non-residents, how do you handle those taxes? Can you allow somebody most at source that basically being taxed at source? Are we together? A non-resident in most cases, you'll not do what? You'll not give them the money without taxing and tell them you pay later. Most of them will tax at source. Naomi, are we together? Most of them will tax at source. Are we together? That is for incomes that are brought together. I hope this information is helpful. Is this information helpful? Yes, I hope this information is very helpful. Yes. So I think advanced tax should not be an elective. It should be a compulsory. Yes, because the knowledge is very important. So we can close it there unless somebody has something that is funny. But I beg to close it there and we meet on. Thank you so much, Harit. God bless you. Unless you have something that is burning that we cannot postpone. But I beg to close it there. So God bless you and God bless us. We can live. Thank you, Zupar. Thank you, Joy. Thank you, Mas. Did you talk about disadvantages of duopoly? If we did, so did you talk about disadvantages of duopoly? Disadvantages of duopoly. Debbie, did you talk about disadvantages of duopoly? Debbie, did you talk about disadvantages of duopoly? We can start from there. It seems we did not talk about them. So on the disadvantages of duopoly, when we talk about disadvantages, advantages of what they call of the duopoly, disadvantages of duopoly. One of the first disadvantages is that consumers are charged high price. We say consumers we say are charged what's called high price. So consumers are basically charged what's called high price. In duopoly, consumers are basically charged what's called high price. The second, since competition is low, the focus is not improving the quality. Since we say competition we say is low, we say the focus we say is not improving what's called the quality. So if you're very keen, we say that oligopoly market, it is basically dominated by few firms. And so if it's dominated by few firms, these firms do not care about what you call quality. These firms basically do not care about quality. So since competition is not there because it's dominated by a few firms, the focus is not quality, goods and services. The next, firms cannot make independence. Firms, we say, cannot make independent decisions. Since, why are they not able to make independent decisions? Since they have to consider the action of other competitors. Since we say they have to do what? To consider what's called the action of what they call of competitor. Since they basically have to consider what they call the action of competitor. Since they basically have to consider what they call the actions of the competitor. Then firms cannot enter into industry because there exist barriers. Firms cannot, the word is cannot, enter what's called the industry, since there's barriers to entry. Since we say there is what's called barriers to what? To entry, because there's definitely what's called the barriers to entry. Since there's definitely what you call the barriers to entry. Then lastly, we can say it leaves customers with less choice due to lack of variety, especially when you have a pure oligopoly. It leaves what you call the customers. It does leave the customers. We say the customers. It does leave the customers with less choice, with less choice, since there is lack of variety, lack of variety, especially when you have what's called a pure oligopoly. Remember, a pure oligopoly, the product they sell is what you basically call homogeneous. Give me a yes if you're together. Then I want to talk about concepts, smaller concepts when you go to national income. So one is what you call duopsony. Duopsony. That is the first concept that I want to talk about. We call it the duopsony. So whenever we talk about duopsony, this is a market where there's only two buyers. A market, we call it a market, and say where the word is there are only the word is two buyers. A market where we say there are only two buyers, there are only two buyers. It's a market that you say there are only two buyers together. Duopoly is basically the opposite of what we call duopoly. Duopoly, there are two sellers. Duopoly, there are only two buyers. So this is opposite. We call it opposite of what we call of duopoly. Duopoly. Opposite of what we call duopoly. Opposite of what we basically call duopoly. Then you have what we call oligopsony. Oligopsony. The next is basically what's called oligopsony. So whenever we touch on oligopsony, we are basically saying that on oligopsony, the market is consists of few buyers. Market, we say, consists of what I call of few buyers. So in this particular one, the market consists of few buyers. Few buyers. It's the opposite of oligopoly. Oligopsony, this is the opposite of what I call oligopoly. It is the opposite of what I call oligopoly. Respond with a yes if you're together. It is the opposite of oligopoly. It is what you basically call the opposite of oligopoly. Then the last item, the smaller one, you can be asked what is the monopsony. So we talk about what we call monopsony. Monopsony. So the last one is basically on a monopsony. So whenever we talk about a monopsony, this is a market that consists of only one buyer. Remember, monopoly, there's only one seller. So a market that consists only one buyer, market that say consists of what we call of only one buyer. So it's the opposite. This is basically opposite. We have it as the opposite of what we call of monopoly. We have it as the opposite of what we basically call monopoly. So this is the opposite of monopoly. So then I want us to proceed to that is the macro. We start on macro. So I start with what's called national income. So I start with what's basically called the national. I hope you have this national income. This handout was basically sent way before. Was this handout sent? Debbie, if you check the group, was sent way before? On the macro, national income. If you're very keen, I sent a number. So on national income, I want us to define two concepts. There's what we call GNP and what we call GNP and GDP. But when you talk about national income is the same as national income. When you say national income, so we need to understand that national income is the same as gross. We call it gross national product. Gross national product. We call it the GNP. So we call it the gross national product. So what we basically call the GNP. So what is national income? National income is basically what we call the gross national product, which is what's called the GNP, which is what's called the GNP. So this basically refers to the value of goods and services. The value of goods and services, we call it the value of what we call of goods. And you say in services, the value of what we call the goods and services. We call it the value of goods and services. We call it the value of goods and services produced in a country, produced. We say in what's called in a country, produced in a country. So the value of goods and services that is basically produced in a country in 1 year, in 1 year, plus what we call plus net factor income. Net factor income, we call it from abroad. Plus what we call the net factor income, we say from abroad. Plus what we call the net factor income from abroad. So when you talk about national income, Debbie, national income is the same as what we call The gross, we call it the gross national, is the same as the gross national product. So how do we get the national income with GNP? GNP, we say GNP should be GDP plus what we call the net factor income, we call it from abroad. Net factor income from abroad. So that is what we call the GNP. So GNP is equal to GDP plus net factor income from abroad. To give me yes, plus net factor income from abroad. Give me only more yes, plus net factor income from abroad. Give me a yes if you're together. So factors to consider when computing GNP. So we call it factors to consider. We call it factors to do what? To consider. Factors to consider. And the word is when computing. The word is when computing. The word is GNP. Factors basically to consider when we are computing the GNP. What are these factors that we need to consider when you're basically computing GNP? Number one, a GNP is measured. Number one is that GNP is measured in money. GNP, we say, is measured. The word is measured in money. We call it basically measured in money terms. We say that the GNP is measured in money in all kinds of goods and services produced in a country. In all kinds of goods and services produced in a country during 1 year. Are we together? But the key thing is that they're measured in current price, then added together. So we need to measure. The word is measured in what's called in current prices. Then you say then added together. So the measured basically in current prices. Then you say they're added together. They are measured in current prices, then added together. They are measured in current prices, then we add them together. They are measured in current prices, then we add them together. Number two, in estimated GNP of economy, in estimated GNP of an economy, in what we call estimated, we call it GNP of an economy, in estimated GNP of an economy, in estimated GNP of an economy, in estimated GNP of an economy, the market price of all the final goods are taken in. The market price of what we call of final goods and services are the ones we say taken into consideration, taken into what's called consideration. So I call it the final price of goods and services is what you basically take into consideration. So when you're estimating the GNP of an economy, it is the final selling price of goods and services. That is what you take into consideration. Are we together? So then the payment received under Social Security, payment, we say received, and you say under what you call the Social Security, payment that basically is received under Social Security, unemployment insurance allowance, unemployment insurance allowances. So the unemployment insurance allowances, we say old age pension are not old age pension, etc. are not included, we say in GNP. So these ones are not basically included in GNP. So payment that are received, number one, we talked about, they're under Social Security. unemployment insurance allowance, and old age pension, we don't include them when you're calculating GNP. Allow me to get it just 1 minute and we come. Together, David. So that is not basically being included. That is not basically being included. That is basically not being included. Together, team. That is basically not being included. So then we get to the next factor. We say that the next we talk about. Taken to see, we talked about profit earned or losses incurred. Profit earned, profit we say earned, or what we call losses incurred. Losses incurred. So the profit that is earned and the losses incurred, and the losses incurred on account of changes on what we call on account of what we call changes, on account of changes in capital asset, account of changes in what we call in capital asset, on account of changes in capital assets, on account of changes in capital assets, as a result of fluctuation, as a result of what we call fluctuations, as a result of what we call fluctuation, as a result of what we call fluctuation in market price, market price is not included in GNP, is not basically included in GNP, is not included in the GNP, is not basically included in the GNP. That is not included in the GNP. Then we can talk about income earned through legal activity, like crime, income included in illegal activity, illegal activities. We say that incomes that are included in illegal activities are not included. We say are not. We say included, are not included. We say in GNP, are not basically included in the GNP. So the income that basically you earn from illegal activity, let's say prostitution, let's say corruption, we don't include them in calculation of what we call the GNP. Together, team, we don't include them in calculation of GNP. So then we go to what's called the gross domestic product. We go to the gross, we call it domestic product. So whenever we talk about the gross domestic product, that is the GDP, we call it the GDP. Together, David, that is what we call the GDP. That is what we call the GDP. JP, if we are there, you give money ways. That is what we call the GDP. We call it the GDP. So what is GDP? So whenever we talk about GDP, is basically the value of goods and services produced in a country in 1 year. The value of goods and services produced in a country in 1 year, and excluding, you don't include net factor income from abroad. Value of goods, we call it the value of what we call of goods and services produced. The word is produced in a country, in what we call in 1 year, produced in a country in 1 year, excluding, the word is excluding, the word is excluding what we call the net factor income from what we call from abroad, excluding what we call the net factor income from abroad, excluding what we call the net factor income from abroad. It's good to see you, Levin. Today you're a bit late in class. Today you are late in class, but it's good to see you, excluding net factor income from abroad. Together. So if you ask today, maybe you go for a TV interview, and I ask what is GDP? GDP is the value of goods and services produced in the country in a period of 1 year, excluding, look up, net factor income from abroad. So we say excluding what's called the net factor income from abroad, excluding what's called the net factor income from abroad, excluding what you basically call the net factor income from abroad. As opposed to GNP, this is the value of goods and services produced in a country in 1 year plus net factor income plus what we call the net factor income from abroad. So if you look at GDP, how would I get the GDP? GDP, how would I get the GDP? So if you look at GDP, GDP would be what we call the GNP minus net factor income, call it from abroad, minus net factor income from abroad. So we call it the GNP minus net factor income from abroad. Give me a yes if we're together. So in simple words, when I talk about GDP, the value of goods and services in a country produced in 1 year, you exclude the net factor income from abroad. So that's why when I want to get GDP and I have GNP, I will less the net factor income from abroad. Together. We'll respond with yes. So then I want to talk about net national product, that is NNP. Net national product, and we call it the NNP. Net national product, and we call it the NNP. So what is the net national product? We say refers to national income, GNP less deposition. GNP, this is GNP less what's called deposition, less the deposition, GNP less the deposition, allowance for deposition, less what we call allowance, for what we call for deposition, less allowance for deposition, less what we basically call allowance for deposition. That has been made. Less allowance for the deposition that we say has been made. So we look up when we are talking about NNP. So NNP would just be NNP, net national product would be GNP, minus what's called minus the deposition, minus what's called the deposition, minus the deposition. So if I want GNP using NNP, GNP would be NNP, net national product, plus the deposition. Plus what? Plus the deposition. Are we able to see that? If we are able to see that, we respond with a yes. We respond with a yes if we are able to see that. If we are able to see that, we respond with a yes. If we are able to see that, we respond with a yes. If you're able to see that, we respond with a yes. Then I want to talk about per capita income. Per capita income. So whenever we're talking about per capita income, this is basically average income of people in a country. We call it average income of what we call of people. We say in what's called a country. Average income of people in a country. Average income of people in a country. Average income of people in a country. So when I look at per capita income, per capita income is equals to GNP over what we call total population over total population. So the GNP minus what's called the total population minus what's called the total population. GNP minus divided by total population. That is the average. We call it the average income of individuals in a country. Average income, we call it of individuals in a country. Average income of individuals in a country. That is what's called per capita income. Per capita income. Together, team, per capita income. So income, when you say that Kenyans live per dollar, how do we know? We basically carry out what's called per capita income. Per capita income. Then I want to talk about real per capita income, what we call the real per capita, call it income, real per capita income. So I want to talk about what we call real per capita income. So whenever we talk about real per capita income, enable us to know average income, enables us to do what to know. The word is to know what we call average income. Enable us basically to know what's called average income and standard of living of the people, and what's called the standard of living of what we call of people. So enable us to know what you basically call the average income and what's called the standard of living of people, and the standard of living of people. So real per capita income, when we talk about real per capita income is equals to what we call real national income, real national income over what we call over the population. Real national income over what's called the population. Real national income over what's called the population. Real national income over what we call the population. Over what's called the population. Together here. So then we proceed to what's called importance of measuring national income. We'll talk about importance of what we call of measuring national income. Why is it important to measure what's called the national income? Importance of basically measuring national income. Give me a yes if you're together. Importance of basically measuring what we call the national income. Importance of basically measuring what you basically call the national income. So what are some of the importance, of basically measuring national income? One of the first importance is national incomes statistic show performance of a country from year to year. Levin, it shows performance of a country from year to year. So when you measure national income, it's able to show performance of a country from year to year. That's the first importance. The second is to basically help judge what's called performance of different sector of an economy. To judge performance of what we call different sector of an economy. To be able to judge what's called performance of what you say different sectors of economy. That's the second. Indicate incomes that accrues to factors of production. The income that accrues to factor of production. We know that labor is wages and salary. How much goes there? We know that entrepreneurship, how much profit goes there? We know that capital, how much interest go there? So how much indicate what accrues to the factors of production. Then we can also talk about is an indicator of growth, is an indicator of country's growth in real income. It's in an indicator, it indicates a country's growth, and you say resulting from increased productivity and increase in real per capita income. Then you say national income is useful in economic planning. So we say the national income is useful in economic planning. So we say useful, number one, useful in what's called in economic. Number one, useful in economic planning. Useful in economic planning. So number one, when you measure it, it's basically useful in economic plan. Useful in economic planning. You are able to forecast economic trends, show performance, national incomes, national income statistics shows shows performance say of a country from year to what to year, from year to year. Shows what you call the performance of a country, we say from year to year. Shows what you call the performance of a country from year to year. Then we say that indicates what you call welfare. It indicates welfare. It indicates what you call the welfare. Welfare, i.e., standards of living. Standards of living. It indicates what you call welfare. What we basically call the standards of living. It indicates what's called the welfare, or what you call the standards of living. It does indicates welfare, or what you basically call the standards of living. It does indicate welfare, or the standards of living, To compare welfare between different countries, we say to compare. We can also use to compare. The word is to compare welfare, call it welfare, between different countries, between what we call the different countries, to basically compare welfare between different countries. We use it basically to compare welfare between different countries. So a good indicator of growth in real income. Good indicator, we call it good indicator. Indicator of what we call of growth in what's called in real income. So this is to say that national income is an indicator of economic growth altogether, resulting from what we call increased productivity. The word is resulting, and we call it from what we have as increased. The word is increased productivity, resulting into what we call increased productivity, resulting in what we call increased productivity, resulting in what we call increased productivity, resulting in what we basically call increased. So it indicates what accrues to various factors of production. It indicates what accrues to what we call to factors of production. What accrues to what we call factors of production. So for example, what accrues to the land is rent. What accrues to labor is wages and salary. So it does indicate what accrues to factors of production. So it indicates the level of saving and investment in a country. Indicates what we call the level of what we call saving and what we call investment, level of saving and investment in what's called in a country. It does indicate the level of investment, level of saving and investment in a country. It does indicate what we call the level of saving in a country. So we say national income Y is equals to C plus S. So that the level of saving and investment in a country. Then S, we need to understand that I know you're wondering. Because you're not seeing income is either consumed, saved. Saving is equivalent to investment together. So useful, we can talk about. It is useful in what we call used in seeking foreign aid. This data we can use used in what? Used in seeking what we call the foreign aid. So we can use it basically to seek what we call the foreign aid. We can use it to seek what we basically call the foreign aid. Used to seek what we basically call foreign aid. So we use it to seek what we call foreign aid. And please always just do your best. In life, do your best. Don't complain. Do your best. Make sure you work as hard as possible and do your best. Don't complain. So that's okay. So are we together up to that point? If you're together, we respond. Importance of national income. useful in economic planning. Statistics we use to show what we call performance of a country from year to year. It indicates welfare, that is the standard of living. It is used to compare what's called welfare between different countries. So it's a good indicator of growth in real income resulting from what we call increased productivity. It indicates what accrues to the factors of production. Then you say indicates what we call the level of saving and investment in the country. Then you use to seek what we call the foreign aids. Then we go to factors that determine the level of national income. Factors that we say determine, factors we say that determines, the word determines what we call the level of national income, level of what we call the national income. Factors that we say determines what we call the level of national income. What are these factors that determines the level of national income? The number of factors. Look at it. We have the natural resources and what we call human resources. A country that has more natural resources than human resources has high level of national income. So we say the first one, we call it natural resources, and what we call the human resources. Natural resources and what we call the human resources. We have what we call the natural resources and human resources. So the higher the quantity and quality of natural resources, higher quantity and quality, and the word is quality of natural, and what you basically call human resources, and human resources, the higher the national income, the higher the national income, the higher the national income. We call it the higher the national income, 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 the higher the national income. We call it the higher the national income, the higher the national income. So then we talk about the next is availability. Availability of what we call capital. So when you talk about capital basically means we can mean resources or cash, but machinery is altogether. So we say exploitation of natural resources requires capital. So exploitation, number one, exploitation requires machine. Exploitation of what we call of natural resources, we say the word is requires capital, requires what we call the capital. So then we have what we call exploitation. And say that exploitation, we say of the natural resources requires what we basically call capital. Exploitation of natural resources requires capital. And capital in this case is basically what's called the machine. Machines. Are we together? Capital is basically what we call the machine. We call it the machine. Capital is what we basically call the machine. We call it the machine. Capital is machine. Are we together? So we say that the higher the capital equipment, the higher the national. The higher the capital, equipment, we say the higher the national income. The higher the national income. The higher the national income. So the higher the capital equipment, the higher the national income. Give me a yes. So we talk about the level of technology. Number three is basically what we call the level of what we call of technology. The level of technology. I can explain this. With higher level of technology, with higher level of technology, the higher the national income and vice versa. So Queen Debbie, with higher level of technology, the higher the national income and vice versa. Give me a yes if you're together. Give me a yes if you're together. So then we talk about prevailing political situation. We talk about prevailing political situation. So we have number 4. We call it prevailing, and we call it political situation. Prevailing political situation. So we look at two things, when you talk about prevailing. So when you have stability meaning there's no war, the country, and we have a scenario of what we call instability. So whenever we have what we call stability, whenever we have what we basically call stability, whenever we have what we basically call stability, so this one leads to higher national income. It leads to what we call higher national income. So this leads to what we call, and this is vice versa. And this is what you basically call the vice versa. It leads to what's called higher stability, higher national income, and stability. This leads to lower, that is the vice versa, lower national income. So then we can talk about terms of trade. We can have the next, we call it the terms of trade. We call it terms of what we call trade. The next, we call it terms of trade. So we have a scenario where we have favorable, then we have what we call unfavorable. We have what's called favorable, and then we have what's basically called unfavorable. So when you have a favorable terms of trade, favorable leads to higher national. This one, higher national income, higher national income. This one leads to what we call the lower national income. This leads to what's called lower national income. That basically leads to what's called lower national income. Give me a yes if we are together. So give me a yes if we are together. Give me a yes if we are together. So give me a yes if you're together. So give me a yes if you're together. So then we talk about the level of employment. Lastly, I can talk about the level of employment. Level of what I call of employment. So we talk about the level of employment. In a country where many people are employed, what do you think of the national income? Higher national income. If the level of employment is high, we have higher national income. If the level of employment is low, we have what we call lower national income. So higher, we call it higher level of employment, higher level of employment. So the national income is high. National income, we understand that national income, we say is high, high and vice versa. High and vice versa. High and what's called vice versa. High and what you basically call vice versa. High and vice versa. High and vice versa. We call it high and vice versa. Together, team. High and vice versa. Together, we respond with a yes. So that is factor that determine the level of national income. Give me a yes if you're together. So then we proceed to the next, we call it circular flow of income. We proceed to what we basically call the circular. We call it the circular flow of what we call of income. Circular flow of income. Circular flow of income. So we call it the circular flow of income. The next factor, we call it the circular flow of income. We call it the circular flow of income. We call it the circular flow of income. We talk about what we call circular flow of income. So whenever you're talking about circular flow of income, is a model in economy that basically shows major exchanges as represented. It shows what we call major exchanges. We call it major exchanges. And we say it as represented. Major exchanges as represented. We call it the major exchanges as represented. As flow of money, as what we call as flow of money, as flow of money, as what we call flow of money, goods and services, goods and services, between, we call it economic agents, between economic agents, between economic agents. And when you talk about economic agents in economics, we have producer, consumers, and government agencies. Producers, consumers, and what you basically call in government agencies. Producers, consumers, and what you basically call the government agency. So then I want us to start with the first type of circular flow of income. We call it circular flow or a closed economy. We call it a circular flow, or closed economy. We call it a circular flow or what we call a closed economy. We call it a circular flow, or what we call or a closed circular flow, and we call it of a closed economy. Circular flow of a closed economy. Magdalene, it's good to see you. Today you're a bit late, but it's good to see you in class. Circular flow of a closed economy. It's good to see you, Magdalene, in a class. It's good to see you, Magdalene. It is good to see you in a class. So we start with the first model, circular flow of a closed economy. So a closed economy, we also call it a three-sector economy. So see what we're doing here. A closed economy is a two-sector, sorry. This is called a two-sector economy. This is also called a two-sector economy. Two-sector economy. We call it a two-sector economy. We call it a two-sector economy. So on a two-sector economy, we call it household. And then we have on this other end, household. Then we have what we basically call the farms. So we have the household, and then we have what we call the farms. So we have this. The thing that, but then we have this. We have that. So together. So then we have what you call, when you have from household to farms. So then we have, when you have farms to household, what is happening? From, we just start from up here, household to the farms. So they provide labor, factors of production. Factors of what we call of production. They're providing labor. Are we together? They're providing what's called factors of production. And Magdalene is saying they're providing labor. Together, team. Are we together? They're providing labor, which is a factor of production. On the other hand, when farms, moving from farm, this is payment. We call it payment. Payment of what we call of factors of production. Of factors of what we call production. We call it the payment of what we call the factors of production. We call it the payment, and you're basically calling the payment of what we call the factors of production. So then from farms, we have from now payment. From farms to the household, this is goods. Farms provide what we call goods and services. They provide now the goods. They provide what we call goods and services. So in return, this is payment now, household payment of what we call of goods and services. This is what we call payment of goods and services. That is what is happening. Payment of goods and services. So I say this is what we call a two-sector. So two-sector means there's only, two-sector basically mean only, there's only household, and the word and farms. There's only household and what we call farms. So a two-sector economy basically means that there is only household and there's farms. There's only household and what we basically call farms. There is only household and what we basically call There's only household and farms. There's definitely what we call the household and farms. Are we together? So we need to understand that household supply factors of production. So household, we don't need to write that. Household, we can see supply factors of production to the farms. If I write it, that would be double. Household provide what we call factors of production to the farms. And farm pay, which can pays for what we call services or factors of production supplied to them. So this is what we call payment of what we call the factors of production. That is, when they provide labor to the farms basically pay the labor. When you look up down here, when you look down here, we basically understand that now in that case, when you have this will give us Y income is equals to expenditure, this relationship up there. Therefore, we can note that, therefore, income of household is equals to expenditure. So income of household is equals to expenditure. Equals to what? To expenditure. Incomes of household basically equals to the expenditure. Give me a yes. So income of household, which is Y is equivalent to E, that is equivalent to expenditure. Give me a yes if you're together. Perfect. Are we together? And I want us to work so hard that I always love encouraging students. A lot of times, you would think about what you're facing, and not wanting to work hard. Are we together? A lot of times, what you face maybe at home, wherever you are, where you work, sometimes can make you not to work hard. Or sometimes the negative energy that is around you can basically make you not work hard. But one of the best things that I can always tell the students to do, don't listen to the voice. Work as hard and make sure that you attain your goal. So then we look on the other hand. If you look at this on the other hand, we're basically saying that on the other hand, farm uses the factor of production while they sell to the household. So the factors of production they produce what we call goods and services altogether. They produce what we call goods and services altogether. So the goods and services that they produce, they're sold to who? Back to the household. Are we together? So output of a farm equals to expenditure. So this is output of what we call of a farm. We say equals to. The word is equals to what you basically call expenditure. Equals to the expenditure. So that is O is equals to E. Output is equals to expenditure. So that is what you have on the second part. Give me a yes if you're together. Give me a yes if you're together. So in summary, so this one basically represents, so we say as an NP represents, so this two sector represents what's called the method. We call it the method. It does represent what's called the method. It does represent the method of measuring national income, of measuring, we call it of measuring national income. It does represent what's called the methods of measuring national income. So it gives rise to three methods of measuring national income. That is the income method, which is Y, income method, which is Y. We have what's called the income method, expenditure method, which is E, expenditure method, which is E, expenditure method, which is E. Then what we call the output method, which is O, output method, which is O, output method, which is O. So this two-sector economy leads to the three methods of measuring national income. That is the income method given by Y, expenditure E, then output method given by O. Together, output method given by O. So I want to talk about the three-sector economy. I want to talk about the three-sector economy. I want to talk about the three-sector economy. So very key. What I'm introducing in three-sector economy, I'm only introducing what you call, I'm only from this, I'm only going to introduce what you call, we're introducing what you call the government. And what happens in terms of government? When you introduce government, there's what you call payment of taxes on both. That is payment of taxes, payment of what you call of taxes, and you say from household and farms, from what you call household and farms. That is payment of taxes from what you call the household and farms. So when you introduce what you call a three-sector, we just introduce what you call the government. And with the introduction of the government, we basically understand that the farms and the household are paying taxes to the government. Are paying what? Taxes to the government. Allow me to draw so that you can see what we are doing. Allow me to draw it so that we can see what we are doing. So now on a three-sector, we can have a household here. Household. We can have the household. We have the farm. And then we have the government. And then we have what's called the government. And then we have what's basically called the government. And then we have what you basically called the government. And then we have what's called the government. Then you have what you basically call the government. Then we have what's basically called the government. So pays taxes, we say pays what you call the taxes. Pays what you call the taxes here, pays the taxes. So pays the taxes. We have this year and that year. So it comes to households, this is now goods and services. So this is what we call payment. Payment of what we call of goods and services. Payment of what we call goods and services altogether. So then this is what we call, this is now what we call factors of production. We call it factors of what we call production. So this is what we basically call, payment of factors of production. You can say payment of what we call of factors of production, of what we call factors of what we call production. Payment of factors of production, payment of factors of production together. So in the this three sector, we've only introduced the government, and both farms and household are paying taxes to the government, are paying taxes to the government. That is what we introduced. So we need to understand that in the three sector, there is existence of what we call government. And what is key, both the household and the farms are paying taxes to the government. So it's the introduction of government, introduction of what we call of government, both household and what we call farms pays what we call pays taxes to what? To the government. Pays what we call the taxes to the government. Both the household and farms basically pay taxes to the government. Give me a yes if we are together. Give me a yes if we are together. Respond with a yes. Respond with a yes. So we talk about what we call open economy or the fourth sector economy. So we call it open economy. So what do you call a fourth sector? economy. Open economy is what we call a fourth sector economy. So when it comes to a fourth sector economy, we basically understand that there is introduction of what we call a foreign sector. There is introduction of what we call a foreign sector. Magdalene, there is introduction of what you basically Levin, there is introduction of what you call a foreign sector. There is what you basically call introduction of a foreign sector. So allow me to draw. Before we go to a break, we finish on this. There's introduction of what we call a foreign sector. There is what you call introduction of what we call a foreign sector. So we have household here. Household. We have the household here. We have farms. We have farms. So that is what you have. Then we have what you call the foreign sector. We have what you basically call the foreign sector. We have the foreign sector. We have the foreign sector. We have the foreign sector. And then we have what you basically call the government. So down here is what you call the government. So we have the government. So we must finish on this before we move to the next thing. Let's make sure we finish on this. So on this, we have number one. So this is buying. So we have this, and then we have this arrow. So the first arrow that comes down is buying security. So this is selling security. Selling security. This is what we call buying security. So there's what you call buying security, and you say there's selling security. There's buying security, and there's selling security. So on the farms, we have what's called, from the farms, we have this, and then we have this, So the first arrow is pay for import. This is foreign sector pay import. And this is pay for what we call pay export. So you have payment of export, and then you have what's called payment of import. So we have the payment of import and payment of export, payment of import and payment of our output. So we have, so this we have, so this payment of import, of what I call of import, So then this run into this payment of exports. We call it pay for export. This is pay for what we call for export. This is what we call pay for export. Then you have pay taxes, pay what we call taxes. This is pay for what we call pay for taxes. Together. If you can see that, we respond to this. Are we able to see the diagram perfectly well? It's good to see you, Neville. Wonderful, wonderful. Good to see you in class. Pay for taxes. So there's payment for taxes that is for both household and farms. So when you talk about an open or a fourth sector, so when you talk about open economy or a fourth sector, there's what we call introduction of what we call a foreign sector. If you look at foreign sector, there's basically in relation to what we call household and farms, there's import and export. But in relation to government, there's what we call buying of security and selling of what we call security. Are we together? So we need to, in an open sector, there is existence, NB, what you need to know, NB, we have existence, so we call it existence of what we call of foreign, we call it the foreign sector. So when you talk about an open economy or a foreign sector, we call it existence. And we say that we work extremely hard. Yes, we don't let challenge make us not work hard. Make sure that my students will work extremely hard so that we pass this paper together. And I will do anything possible in revision and in class so that we just make sure that we get there. So there's what we call existence of what we call foreign sector and what we call the government. That is a unique thing in the government. So if you look at the government in place, we understand what happens in relation to the government. We understand that the household and the farms are paying taxes to the government, together. But you're also saying that when you look at government vis-a-vis the foreign sector, there's what we call selling and buying of what we call security. Are we together? So, and we also have the foreign sector and the farms. We have what we call import and export. Are we together? So in addition to what we call government, whereby the household and farms. So we have household and farm paying taxes. We don't need to write household and farm paying taxes to the government. So we say that import supply to foreign sector. So household supply import to foreign sector, supply what's called household pay for import to the foreign sector. In return, foreign sector pay for export. Again, in relation to farms together. So on the other hand, we can see the government buying and selling of security. That is a fourth sector economy. Give me a yes. Give me a yes if we're together. Give me a yes if we're together. So I want us to talk about this before I give you a break, before you go to the methods of measuring. Assumptions of a circular flow of income. Assumptions. We'll talk about assumptions of what we call of a circular flow of income. And you say in a closed economy, So when you hear the word closed economy, that is what's called a two-sector economy. In a closed economy, and when you hear the word closed economy, that is what you call a two-sector economy. So what are the assumptions that are basically made in a two-sector economy? Number one, it consists of only two sectors. That was the first diagram, consists of two sectors. So one of the first assumptions is consist of what we call of two sectors. And if you're very keen, two sectors, I don't want us to cram, but I want us to be very keen. It consists of what we call two sectors. And two sectors, when you are very keen, there was only household and farm. That is household, and what you basically call farms. Existence of what we call two sectors, and that is the household and farms. The second, household spend all their income. Household, we say that household, the word is spend all their income. They spend all their income. So they spend all their income. The income that they earn when they supply factors of production, spend their whole income on goods and services, on what you call goods and services. So that is Y is equivalent to expenditure. That is Y is equal to expenditure. So there is consumption and there's no saving. So if they spend, it means there is consumption. There is basically what's called consumption. But what? But no saving. Are we together? There's essentially consumption, but there's no saving. Look at what we say. We say that Y is equal to expenditure. So the income that they make basically by supplying what we call factors of production, they spend it in buying all goods and services altogether. So if they spend all that income We are basically saying that there is consumption, but we do not have saving in a two-sector economy. The third is that there is no financial sector. There is no financial sector. There's no banks. There's no, we call it financial sector. There is not what we call a financial sector. If you look at the two-sector economy, there's not a financial sector. If you look at that economy, there's not a financial sector. We call it a financial sector. There's not a financial sector. There's no overseas sector. There's no foreign sector or overseas. No overseas. Overseas, we call it sectors. There is not an overseas sectors. Then you can say a closed economy with no export and import. Closed economy with no export, and the word is import, with no export and import. A closed economy with no export and import. So there is no government sector. We didn't see the government sector. No government sector again at the last. No government sector. There's not a government sectors. So that is on assumptions of a two-sector economy. So as we take a break, we come back on methods of measuring national income. Methods, we call it methods. Methods of what? Of measuring. We call it methods of measuring national income. Methods of measuring national income. We also call it approaches to national income. We call it approaches to what? Approaches to national income. Call it approaches to national income. And work hard, my team. Yes. Work hard, extremely hard, then we make it. So we can have a small break. Is that noted? If we can have a small break, then we respond to this. Together, Magdalene and the team, we can have a small break. Methods of measuring. Measuring national income. Method of what we call measuring national income. So if you look at the first circular flow, which was a closed circular flow, we had what's called the income approach, which is Y, expenditure approach, and then we had what we call the output approach. So we start with what's called the income approach. So we start with what's called the income. We call it the income approach. Income approach, that is why. We start with what's basically called the income approach. So we start with what's called the income approach. So when it comes to income approach, we're basically saying that this is the word that we're adding all factors, income accruing to factors of production, adding all factor income, adding what we call all factor income accruing to what's called to factors of production, accruing to what's called factors of production, accruing to what's called factors of production, adding what's called all factor income, all factor income, we call it accruing to what they call to factors of production. So we say that when it comes to labor, the factor income that accrues to labor is the wages, wages or what's called salary, which given. So then if you're looking at national income, when you're using the income method, we say that the national income equals to national income, we say equals to. So we're saying that for land is total rent, we say equals to total rent. That is total rent. Total rent. We say total rent. Total wages and salary plus total wages and salaries. Total wages and salaries plus total wages and salaries plus what we call total interest, total interest, total interest. Interest accrues to what we call capital plus total profit, plus total profit together. So what accrues to further factors of production? Land, we know is rent. So the total rent in 1 year, we add them. To salaries, to labor, we have total wages and salaries. So we had total wages and salaries. To capital, we have interest. So we have the total interest. And then finally, to entrepreneurship, we have what we call profit. So we had the total profits for a whole year. So we get the national income using what we call the income method. Magdalene, is that understood? Neville, is that understood? Queen and Deborah, is that understood? Queen and Deborah, is that understood? Perfect. So we're basically going to say that the GNP is equals to wages. Wages now is for labor plus rent plus I, which is interest, then plus P, which is profit. That goes to the entrepreneurship. That goes to the entrepreneurship. Are we together? So that is how we use the income method. We had all factor incomes that accrue to the factors of production. We know that when you talk about labor, we have wages and salaries. When you talk about land, the factor income that accrues to land is rent. When you talk about capital, the factor income that accrues from capital, that is interest. Then finally, the factor income that accrues to entrepreneurship is what we call the profit altogether. So we need to understand that according to what we call income method, we have total wages, but there's what we call adjustments altogether. So we call adjustments to the income method. What we call this, sometimes we call adjustments. We call it adjustments to income method. Adjustments to the income method. Are we together? Adjustments to the income method. Before I talk about those adjustments, I will repeat again that GNP, I just say GNP is equals to wages plus salaries, wages and salaries. Wages and salaries is equals to the wages and salaries. Rent plus what we call plus interest. Rent plus interest. Rent plus interest plus dividends altogether. Plus what we call plus dividends. Then you say plus undistributed corporate profit plus undistributed, distributed. We call it corporate profits, undistributed corporate profits. Then you say plus mixed income, plus what's called mixed income. Then you say plus mixed income plus direct taxes, plus the direct, we call it the direct taxes, plus the direct taxes. Then you can say plus indirect taxes, plus indirect taxes. Then plus what we call those adjustments, we have what's called plus depreciation. Then say plus net factor income, net factor income. We call it from abroad. Are we together? Plus what's called the net factor income from abroad. So what are these adjustments to the income method? So adjustments to the income method, we have net factor income. One of it is net factor income. If you say from abroad, net factor income from abroad. We have the net factor income from abroad as one of the first adjustments. We have what's called the transfer payments, transfer payments. We have the transfer payments. We have deposition. We have the deposition. We have indirect taxes, indirect taxes. We have subsidies, and then we can have what you basically call appreciation. We have what you basically call appreciation. Call it appreciation. And then we call it appreciation. So this is the adjustment to the income method. Allow me to introduce what we call expenditure method. The second method, we call it expenditure method. So expenditure method, we represent it by E. Allow me to introduce the second method, we call it expenditure method. We introduce, so involve adding expenditures in the economy. So we say that involves adding all expenditures. So we call it involves adding what we call all expenditures in what we call in the economy. Involve adding all the expenditure in the economy. It does involve what we call adding what's called all the expenditure in the economy. So you add all the expenditure in the economy. So what are some of the expenditure? We know that income, as one of the expenditure, is consumption. Income is basically consumed. One is, we have what's called investment. Some goes to investment. Some goes to what's called government expenditure, or some goes to government expenditure. So if you're looking for GNP, according to this method, so we need to have, according to the method, we need to understand that GNP is equals to consumption plus investment plus government expenditure. Then say plus X minus M. So X is what we call export, and M is what we basically call import. So this is assuming that there's not what? There's no net factor income from abroad. There's no net factor income from abroad. If there's net factor income from abroad, if we have a scenario where we have net factor income from abroad, then we'll have the GNP being equals to C plus I plus G plus X minus M. Then we P minus, this is the net factor, P minus Q. This is to get the net factor income from abroad. So I want to synthesize each. So C stands for what we call consumption expenditure. C is what we call a consumption expenditure. C is basically consumption. We call it consumption expenditure. C is what we call a consumption expenditure. So I is what we call investment expenditure. We call it the investment expenditure. I is what we basically call investment expenditure. That is high, we call it investment expenditure. G is what we call government expenditure on final goods and services. G is government expenditure. We call it the government expenditure. G is what we call the government expenditure. We call it the government expenditure. That is G. We call it the government expenditure. Then we have X. Total X stands for export. So X is export. That is export of goods and services. Export of goods and services within a country. Then we have what's called I is what's called, M is what's called import. M is basically import. M is what you basically call import. Then finally, P represents local working abroad. Are we together? P, this is the net factor. So P is locals working, we call it working abroad. So when you less P minus Q, then you have the Qs, locals working abroad, income of foreigners working locally. So this is the income of foreigners working locally. So incomes of foreigners, we call it working locally. Together, working locally. Together, team, working locally. Together, to give me yes. So adjustments to what we call expenditure method. We can talk about adjustments towards to expenditure, call it expenditure methods. Adjustments to the expenditure method. So whenever we're talking about adjustment to the expenditure method, we have export, import, import. We have the export, we have the import, we have what's called the net factor income. Net factor income, we call it from abroad. Net factor income from abroad. We have the net factor income from abroad. We have what's called indirect taxes, subsidies, indirect taxes, subsidies, etc. Subsidies, etc. Subsidies, etc. Give me a yes if you're together. Subsidies, etc. Subsidies, etc. So we are done for that today. So in the next class, we start from what we call the expenditure method. We start from what we call output method. Sorry, we start from the output method. So far, we are doing well. Are we together? We are about to pick our papers and start revising. We are about to pick our papers. The blocks officially starts on 23rd, but we're about to pick our papers to start. So I want to say that God bless Levin, Debbie, Magdalene, and even we had who? We had one of us who was just left. So thank you so much. Keep up the good work. Keep up the good work. Thank you so much. We can't stop it at that point unless somebody has a question. Unless somebody has a burning question. Unless somebody has a burning question that cannot be postponed. So we can wrap it there for today. that we are recording. But this unit basically is supposed to equip you, the candidate, with three things. One is the knowledge. We'll call it the knowledge. The second is what's called skills. And the third basically is what we call skills, knowledge, skills, and what we basically called attitudes. So it's supposed to keep the learners or the candidates with three things. So we have the knowledge, skills, and attitude. And this knowledge, skill, and attitude is supposed to help you to handle what? To be very specific, this is supposed to help you handle tax issues altogether. So we break it to say that it's supposed to assist you, that will enable him or her, that enables him or her to do what? To understand. We call it to understand what we call the complex tax issues. We'll call it the complex tax issues that will enable him or her to basically understand what we call the complex tax issues. Let me mute everybody. To enable him to understand what we call the complex tax issues. Are we together? Complex tax issues, because you're not just talking about companies in general, but you're very specific to companies. So we call them complex tax issues. Implement what we call tax planning. Basically call it implement what we call the tax planning, which basically you referred to what we call the tax, which you refer to as the tax avoidance, to be able to implement tax planning initiative, to be able to implement what we call the tax planning initiative. So whenever we talk about the tax planning initiatives, we're basically talking about initiatives that you can basically use to reduce what we call the tax payable by a taxpayer, but you're precisely saying that in what? In a legal way. Are we together? So then, again, lastly, administer taxes in various businesses. We call it administer what we call taxes in what's called various businesses. You do not study just tax in terms of general, but now we understand that you are able to do what? You are able to administer tax in what we call in various businesses. Like I was saying, now Joy will be able to understand how to tax the banks. Joy will be able, if you are employed in an insurance company, you will be able to know how to go about taxation in an insurance company. We respond with a yes if you're there. Is that understood? If that is understood, you give me a yes. If that is understood, you provide me the yes. Give me a yes if that is understood. If that is understood, perfect. Let me just get a dust of the way. So perfect. So we get to what's called learning outcomes. What's basically called learning outcomes. We call it the learning outcomes. What we basically call the learning outcomes. A lot of times there's always a misconception. Maina, if you're with Maina, there's always a lot of misconception that it's just about passing. But again, also a candidate who successfully go through what they call the advanced taxation, there's some of the things that they should be able. Are we together? So a candidate that basically passes this paper, that is Maina, Liz, and Joy, a candidate that was able to pass this paper should basically demonstrate a number of things. If you pass this paper and you truly went through the class perfectly well, you should be able to demonstrate what you call a number of things. One is to basically compute tax liabilities of enterprise altogether and specialized business. To compute, one is basically you should be able to compute what we call the tax liabilities, liability, and we call it for enterprises, and what is call specialized and specialized businesses. So a candidate who successfully goes through this unit and is able to go through it well and passes the exam should be able to basically calculate what's called the tax, compute what's called the tax liability for enterprises and what's called the specialist business. That's one thing a candidate should be able to do. So the second, under what's called value added. One of the very common topics that it has to be there. You know, the topics that when I teach you this tax, I will tell you these ones have to be there. Handle value added tax computation. You should be able to handle. This is a question that never misses. Handle what's called VAT computation. You will not miss this in an exams for advanced taxation. This is one of the trick. You will have what's called the value added tax computation. You should be able to handle what's called the value added tax computation. So a candidate who successfully pass advanced taxation should be able to handle what's called the value added tax computation, explain tax dispute resolution mechanisms. We call it explain tax dispute resolution mechanisms. So particularly, we will delve deeper when it comes to advanced tax, that is Joy and minor. We will be able to delve deeper. What we call explain what's called dispute resolution mechanisms. We will be able to delve deeper even into the ADI, touches to the ADI. As opposed to the PFT, we were not very detailed into what we call tax dispute resolution mechanisms. But now on advanced tax, we shall be able to delve deeper into what we call tax dispute resolution mechanism altogether. Then cross-border activity. Should be able to explain what you call one-stop border shop, explain cross-border activities. Explain what's called the cross-border activities altogether. Cross-border activities, business activities. But particularly as I expound on it, I want you to understand what I'm saying. If you look at the intermediate, we say that a resident person is taxed on income earned from anywhere altogether. If he earns income outside the country, it should be taxed. If they earn, for example, I will be able to discuss, for example, athletes that compete. How do you go about taxation of athletes? Let's say, for example, Kipchoge has gone for a London race. How do you get to tax Kipchoge? Are we together, Joy? How do you get to tax Kipchoge? Are we together? Because somebody will say, if you say a resident person should be taxed on income earned from everywhere, how do they handle that? So particularly on cross-border, we are going to talk about issues with one-stop border shop, but also we're going to talk about at depth on those cross-border, what we basically call double taxation, what we call the double taxation relief, which is an introduction to one of what's called the tax credit, an introduction of a tax credit. Remember, this is a tax credit where we are going to talk about two concepts. I am going to talk about the exemptions method, and I'm going to talk about exemption method and the credit method. Is that understood? Then, for example, develop tax policy. If you're a good student and you go through advanced tax properly, develop what's called the tax policy. You need to come up with the tax policy. So that is a learning expectation. Is that understood? If that is understood, you give me a yes. Kindly respond with a yes if that is understood. Maina, Liz, and John. Maina, Liz, and John. Maina, Liz, and John. Perfect. So advanced taxation. So we now get to the content. We now specifically get to the content. When you look at advanced taxation, we essentially have 9 topics, about 9 topics. We have essentially about 9 topics. This is what we expect, but very good, interesting, and more applicable 9 topics. 9 topics. So we have the 9 topics in advanced taxation. We have 9 topics in advanced taxation. So that is what we call the content. The science call it the content. We call it the content. So what it is can call the syllabus. Contents to what we call the syllabus. So on the contents to what we call the syllabus, the first topic is basically what we call taxation of taxation. We call it taxation of business and specialized activities. Taxation of what we call of business. We call it the taxation of business and specialized activities. And specialized activities. And specialized activities. So under this, the first thing that you break out of that altogether, that is in general. So we're going to have limited company. So we'll be starting as one, topic one. We call it taxation of what we call partnership. Taxation of what we call partnership. Taxation of what we call the partnership. But I want to introduce what is very interesting about taxation of partnership and advanced taxation. Under the advanced taxation of what we call of the partnership and advanced taxation. If you look at the intermediate, I think I taught Liz and I taught Joy. Is that true, Liz and Joy? Liz and Joy on the intermediate. Probably I've taught Maina somewhere, but if I taught you on the intermediate, you should. So under partnership, you understand how to tax a general partnership. What we did was a general partnership. Before you know what you're doing, so on the advanced taxation, I'm going to introduce a number of things in partnership. I'm going to introduce perfect. I am going to introduce what happens when we admit a partners. Remember, under intermediate, we don't talk about partnership as expanded. I'm going to talk about what happens when you introduce a new partner in a partnership. What happens when a partner retires? What happens during the year? But you're also going to talk about conversion of a partnership. When you convert a partnership to a limited company, what happens altogether? But also very important, incomplete record. So on this, three things that I've mentioned are together. Three things. We are basically going to touch on admission and what we basically call a retirement. We call it retirement of what we call a partner. We are going to discuss admission and what we basically call retirement of a partner. So which we were not doing. So now I introduce it there. What is going to happen? Very interesting. Then conversion of partnership to a limited company. We're going to talk about conversion of what we call partnership to what we call to a limited company. Allow me just to say something very interesting in tax, because tax is very applicable and very interesting. So when for example, I say that we don't tax partnership, that concept still applies that we did in the intermediate. Well, people say that we don't tax partnership, but we tax individuals in the partnership. However, when you convert a limited company is being taxed on its own, is a legal entity separate from its owners. So initially, on the partnership, we were taxing individuals. But now when you convert partnership to a limited company, the company can now be taxed. Company can now basically be taxed. But also very important, under partnership, you realize that, for example, payments to partners were an allowable expense. However, when you convert this partner to a limited company, the partner changes to who? When you convert partnership to a limited company, the name of partners changes to who? The name of the partners will change to what? Directors. So payments that are directed over a limited company to directors now becomes allowed. Remember, under partnership, are we together? Under partnership, the payments to partners are non-allowable. But when you convert the partnership to a limited company, now payments that are directed over the directors, like director salaries, now becomes allowable. So incomplete records pertaining partnership. We'll also talk about incomplete records. We call it records pertaining. We talk about pertaining. We call it pertaining to what? To partnership. Pertaining to what we call the partnership. So the incomplete records, and we say pertaining to what we call to the partnership. So the incomplete records pertaining to partnership.
Very interesting. For those students who are able to attend my PFT class, I was able. How do you get credit sales? How do you get credit sales? Credit sales. We understand total sales. Sometimes you're not given the also. How do you get the credit purchases? Credit purchases. Are we together? How do we adjust accruals? How do we adjust accruals? How do we adjust what's called the prepayments? I shall be able to discuss that. That how do we adjust credit sales? You open debtors control account to get what's called the credit sales. You have to cash sales, then you get the total sales. Then the credit purchases on here. On the credit purchases, we basically call it on the credit purchases. We basically now call it on the credit purchases. We simply say on the credit purchases, you all open what's called creditors control account, where you get the credit purchases. If there was cash purchase you add, then you get the total purchase. But allow me to expand on it. I'm doing all this so that we understand, this thing at length. So with this concept in complete records under partnership, this is very key. Remember, partnership, I'm also giving a trick. Partnership is also one of the compulsory questions you cannot miss. Partnership is compulsory. You'll always find that as a compulsory question. Partnership is a compulsory question. Together, partnership is a compulsory question. You will find that this partnership is a compulsory question. So that is on the partnership. Together, respond with yes if we are there. If we are there and we enjoy the class, we give it a yes. Tafadhali, give it a yes. If you don't understand something, then you also let Mwalimu know. Remember, we are here for you. Are we together? So then again, also very important, case laws. I will be talking about case laws, a little bit of case laws pertaining. Some of the cases that are basically emanated as a result of partnership. Then you have what you call limited companies. The second should basically be called what you have as limited. Call it the limited companies. Limited companies. We have it as limited companies. We will have it as limited company. So under limited companies, very interesting. Taxation of companies. And you'll find that it's a little bit different from AFR. Taxation of companies. Taxation of what we call of companies. Taxation of companies. So under taxation of company, we are going to talk about how do we tax holding, what we call holding company. Holding is the same as parent company. We talk about subsidiary company, and other related companies, related companies. So when you talk about a web of relationship, are we together? When you talk about a web of relationship, and this you have discussed in FR, we have what called, when you talk about a web, we have subsidiary, we have joint venture, and then we have what called the associate altogether. Associate. So when you talk about subsidiary, you control more than 50%. A joint venture should basically be 50-50. Then an associate should be 20, but not more than 49 together. Should be 20 and above, but not more than 49. Elizabeth, Liz, are we together? Are we together on that? We'll talk about related company, how companies are related. But now very interesting in tax, if you're very keen, very interesting in tax, you see a parent company and a subsidiary that tax independently. Are we together? A parent company and a limited company are taxed independently. We don't tax them together. Join to pamoja is just, this is a walk through the concept line. I just want us to enjoy. It's not a class, but it's just a preview of what we are going to start on Sunday. So when you have a parent company join and a subsidiary company, you tax them independently. together. When you have 50-50, joint ventures, we tax them also separately. However, the ones that we tax together, this is head office. When you see head office and branch, now in relationship, we tax them together. So when you give an equation that touches on head office in the branch, we combine. Head office in the branch, we basically do what? We combine. When it comes to head office in the branch, we will basically understand that those ones we tax together. And therefore, we do what? We basically combine for that together. We're also going to talk about incomplete records pertaining to partnership. Call it records pertaining to what we call partnership. Incomplete records pertaining to limited companies. So we are going to have that incomplete records basically pertaining to the partnership altogether. We're also going to talk about shortfall tax computation. Shortfall, we call it tax computation. Shortfall tax computation. We are basically going to talk about the shortfall tax computation. We are going to touch on the shortfall tax computation. We are going to talk about taxation of dividends. Taxation of what we call the dividends. How do we tax dividends? So we understand that dividends are three categories of dividends. Dividends exempted from tax, we don't charge tax. The non-qualifying dividends, where the 15% withholding tax is not final, we still subject them to further taxation. And then we have the qualifying dividends altogether. So then we talk about taxation of what we call, we'll have taxation of what we call rental income. Are we together? Rental income, incomes, and RTIs. We are going to talk about rental income and RTI. You see, I always ask individuals, for example, a real estate company, how would you tax a real estate company? Would you tax it in form of capital gain? Would you, like a once-off transaction? We say that CGT is basically taxation on transfer of property. What about real estate? Because real estate is basically also transfer of property. Do you think we tax real estates like CGT? Would you tax real estates like the CGT, Lizzie? Would you tax real estate like the CGT? Would you tax what you call the real estate? Real estates are business, and they're more commercial. So the tax the same. But now when you have the once-off transactions like the CGT, then those are capital gain transactions that we get what? We get the 15% of the capital gain. Give me a yes if we are together. So we're also going to talk about, as we summarize on this topic too, capital gain CGT. We're also going to talk about CGT, capital gain taxation. We're also going to talk about taxation of cooperative and SACCOs, taxation of what we call cooperatives and SACCOs. How do we go about taxation of the cooperatives and SACCOs? How do we tax cooperatives and SACCOs? Are we together? Financial institutions, how do you tax financial? We have them as financial institution, i.e., we have the banks and what's called insurance companies. How do we tax the banks and the insurance company? How do we tax the bank and the insurance company? Are we together? I want to ask a very interesting question. What is the major source of income for the banks? What is the major source of income for the bank? What is the major source of income for the banks as a financial institution? And what is the major source of income for the insurance company as a financial institution? what is the major source of income for the bank? The major source of income for the bank is interest on loans. Are we together? On the other hand, the major source of income is premiums. Are we together? So it's you see, when you're introducing, I always like tell somebody that the backbone, you see what I'm going to do after discussing the coastline, I'm going to build on the basics because I cannot start on the bank before I build on the bank. I will be building on what's called the basics. So I will, for the bank, I'm going to introduce additional taxable income and additional allowable expense. Apart from the ones that we knew on the PFT, I will be basically introducing what we basically call additional taxable income and additional allowable expense and additional allowable expense. Additional taxable income and additional taxable allowable expense altogether. Taxation of extractive. Taxation of what we call of extractive industry. This is the mining industry. How do we go about mining industry? We'll talk about how we tax the mining industry. Taxation of the extractive industries, that is the mining industry. Taxation of extractive industry, that is the mining industry. We'll also talk about digital taxes. Digital service tax, we'll touch on the digital service tax, the digital service tax. Taxation of sea and air undertaking, sea, and what we call in the air, we call it undertaking. Sea and the air undertaking. Taxation of what we call sea and air undertaking. Taxation of what we call the sea and air undertaking. Then we have what we call trade association, club city, trade association. How do you tax trade association clubs, etc. So I will also be privileged to talk about case law. Maybe one, I'll just try to talk about case laws in relation to taxation of companies altogether. So agency, how do you tax agency consultancy fee? Are we together? We'll talk about consultancy fee. How do you tax consultancy? Agency, collective investment scheme. That is on topic 2. Respond with a yes if we are together. That is on topic 2. So that is what we expect in topic 2. Give me a yes if that is understood. Is that understood? Provide me the yes if that is understood. Topic 2. Then let me proceed to topic 3, which is a compulsory. We say partnership and VAT. Those are constant questions that you get in when you go to exam, you'll have them. So we have topic 3, that is value added tax administration. We call it the valued added tax, and we call it administration. Value added tax administration. So this is always a compulsory question. You'll get it. What's the learning outcomes? A student should be able to do what? A student should be able to carry out value-added tax administration, understand penalties in taxation, understand issues to do with tax points, understand which goods are vatable, which services are vatable, which services are exempted, which services are zero-rated. A student should be able to together. So under this obligation, so we have what's called obligation of what we call a VAT. We call it registered person. Obligation of what we call a VAT registered person. What is the obligation of a VAT registered person altogether? So when we talk about VAT computation, you should be able to know what we call VAT computation, which is very common. Maybe computation, calculations will be maybe 1 or 2 offenses in VAT. Then we talk about restriction of input VAT claimable. Restriction of VAT input claimable. This is where we have what we call, where we have exempt supply. Are we together? VAT restriction happens when you have what we call the VAT exempt goods together. Then you have what we call VAT refund and bad debt relief. Refund, we'll talk about refund and what we call the bad debt relief. fund and what we basically call the bad debt relief. We'll touch on the bad debt relief, VAT account certificate, automated system. I will try and talk about the VAT automated system, Then lastly, we normally have case laws related to case laws. We have the case laws related. We call it related to what we call related to what we call to the VAT. Case laws that essentially relate to the VAT. Together, team. Case laws that are essentially related to the VAT. Give me a yes if we are there. We'll respond with a yes. So then topic 4, a topic that is very interesting. Topic 4 will be what you call tax investigation. Tax investigation. Joy, have you ever asked yourself what happens? You have not kept your records. You have not kept your record, let's say for 20 years. You have not kept what you call your record for 5 to 20 years. How does Kenya Revenue go about and basically will know how much tax you need to pay? Have you ever asked yourself that, Joy? That I have not kept my record. Let's say, for example, I have not kept my record for 5 years. I have not kept my record for 5 years. How will Kenya Revenue Authority arrive at saying that I'm supposed to pay tax of 10 million? What do they do in order to do that? That is what you call tax investigation. What are the sources of tax investigation? What will lead to tax investigation? So one of the things that we're going to talk about is tax fraud. That is one of the aspects that leads to tax investigation. Tax fraud or tax evasion. Remember, tax fraud is tax evasion. Are we together? Then we talk about civil and criminal investigation. Touch on civil, what you basically call civil, and what you have as criminal investigation. Civil and what you call the criminal investigation. We'll expound on the civil and what you call criminal investigation. We'll touch on the civil and criminal investigation, events that trigger what you call tax investigation. Events that I would briefly talk about events that what you call that triggers what you call tax investigation. Events that will basically trigger what you call the tax investigation. What are these events that will lead to tax investigation? You know, what will lead to tax investigation? You know, your life is we look at your tax, the taxes that you're paying, and your life, we wonder what is happening. So, you know, events that trigger tax investigation, we shall talk about what's called events that will basically trigger what we call the tax investigation. Events that will basically trigger what we call the tax investigation. Then now, what I was talking about, back duty or in-depth examination. How now we get to know tax that you need to pay. We call it back duty, or what we call in-depth tax investigation. Back duty, so what we call in-depth tax investigation. So we look at your asset, we look at your liability, we look at non-allowable, we look at the non-taxable income. We're able to know the tax that you need to pay in a year, and very interesting, we'll shall have that. Then custom and excise investigation. We'll talk about briefly also custom and what's called excise investigation. Custom and what we precisely call excise investigation. Custom and the excise investigation. We'll also talk about types of tax audit and their significance. Tax audit and significance. Tax audit and what's called and their significance. And there we call it significance. Tax audit and what's called their significance. So we talk about the various tax audit and their significance, but we also talk about what's called penalty enforcement of outstanding taxes. You know, when you carry out in-depth investigation. So what are some of the penalties that basically emanate when you do not pay tax for a long time? Are we together? So again, at the end of it, I will also be trying to tell case laws in relation to that. case laws. We have the case law. Is topic 4 expounded perfectly well on what you need to know? If it's expounded, you respond with a yes. If it is expanded, then we respond with a yes. Then topic 5, before I give you a small break. Topic 5 are the magic issues for those who are practicing tax. Tax dispute resolution mechanism. Tax dispute resolution mechanism. Tax dispute, we call it dispute, and we call it resolution, and we call it mechanism. Tax dispute resolution mechanism. Call it the tax dispute resolution mechanism. The tax dispute resolution mechanism. So we'll first of all define what we call the tax dispute. We'll talk about what we call the tax dispute. The tax dispute. We'll define what tax dispute and how to go about it. So stages of tax dispute resolution. Stages. Call it stages of dispute. Dispute resolution. Where we talk about where some cases commissioner and the taxpayers itself there. You can go to the tax tribunal, you can go to the courts and the ADR together. Then we talk about legal framework and objectives of tax legal framework. What support this legal framework and what called and objectives of tax dispute resolution mechanism. So what we call legal framework. What are this legal framework? Maybe ADRs. They're informed by what legal framework supports the ADR. So we'll talk about types of dispute resolution. ADRs, so to be specific, we'll talk about the ADR, ADR in depth, benefits of ADR, we'll touch on benefits of ADR, we'll touch on the benefits of ADR. Sometimes people wonder, again, you learn, for example, that the disputes that never go to even the income tax tribunal, they simply add to the ADR. There will be commissioner, then they just go to the ADR. So what is ADR? What is the benefit of ADR? Are we together? So we'll also talk about parties to ADR. Who are they basically involved in the ADR? Parties to what we call to ADR. To the parties to ADR. Who are the parties to the ADR? We'll talk about termination of dispute resolution. How do you termination? We call it termination of dispute. So we call it the termination of dispute. How do we bring disputes to an end? Are we together? How do we basically bring dispute to an end? That's topic 5. Is that understood? Patia mwalimu yes kama tuko pamoja. Give mwalimu yes if you're together. Thank you, Kaburu. Thank you, Kaburu. Allow me to discuss 6, even as I give you a break. Allow me to discuss this taxation of cross-border activities. So we call it taxation. Call it the taxation of what we call of cross-border activities. And I mentioned something, athlete. We have the Kenyan athlete who go for London race, they go for the New York race. How do you get to tax them? Those are cross-borders altogether. So we'll talk about trading and trading in distinction. We'll talk about trading in, and trading with other countries. Trading with other countries, with what you call with other countries. So what is the distinction of trading in and trading with other countries? The distinction between trading in and what you call trading with other countries. The distinction of basically trading in and trading with other countries. We are going to talk about that. Double taxation agreement. So on the double taxation agreement, if you're very keen, double taxation agreement. Because essentially, if we were to say, and these are concepts that we have touched with my good students, we say that for a resident person, income is taxed from wherever, whether you're in New York, So, but the question is, if we say like that, if the tax in the other country and tax in this country, would it result in double taxation? Yes. But now there's what's called double taxation agreements, where countries can agree on a two number of clauses. There's the first clause that we call the exemption. The countries will say, the two countries will agree that if our resident is working in Kenya, then they will be exempted from tax in their country. If they're taxed in Kenya, we don't tax them. But the second type of a clause, we call it credit clause. So the credit clause is basically they provide what we call a double taxation relief, where they're comparing the tax that is charged outside, and then that income subjected to Kenyan income, they also get the tax. Then they get the lower of the two. So that is what's called double taxation agreement. But precisely because the credit method is what leads to questions, so we'll tackle a lot on the credit method. We'll basically touch a lot on the credit method. We'll basically touch a lot on the credit method. We'll basically touch a lot on the credit method. So then we're also going to talk about regional integration, COMESAs and etc. What we call the regional integration. Issues to do with COMESAs. What is the benefit to East African community? How they harmonize the tax tariffs, and that's the question that was there. When you talk about regional integration, one of the things they harmonize what you call the tax policy altogether, where you find these companies, these countries objected to a common tax altogether. So the most favored nation. I'm also going to talk about most favored nation status. What do you call the most favored? Call it the most favored nations. So we'll talk about the most favored nations. The most favored nations. I will be talking about the most favored nations. Characteristics and significance of one-stop border shop. One-stop border, OSPPs, altogether. One-stop border shops. So very interesting now. We're going to talk about one-stop border shop. What is the significance altogether? Then we talk about general system of preference, AGOA. We're going to talk about general. We'll talk about it called generalized system of preference and AGOA. Tax havens. Why do rich people take tax havens? I'll talk about where tax havens, and treaty shopping, treaty shopping. What is the significance of tax havens? We basically understand that tax haven is where taxes are not even charged at all, or taxes are minimal. And this is where you find rich people will take their money. Examples of a tax haven. One example of a tax haven. An 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 example of a tax haven. Countries, I'm saying tax haven countries. Examples of a tax haven: Panama, Cayman Island, those are tax havens. Are we together? Then we go to transfer pricing. Lastly, let's talk about transfer pricing. We'll touch on the transfer pricing. And we have what we basically call case laws relating to cross-border. We have them as case laws that relate to what we basically call taxation of cross-border activity. That is topic 6. Respond with a yes if we are there. Respond with a yes if we are there. If that is responded perfectly well, then let Molimono. Are we together? Lazy, are we together? Maina, Kapuru, and George. Are we together? Perfect. So then, as we take a break to come back, topic 7 is basically tax planning. What you're calling tax avoidance. We call it the tax planning. So this is where we come back and start. We call it the tax planning. We call it the most favored nations. So it's a concept that we're going to talk about. We call it the most favored nations. Are we together? Anna. Yes, most favored nations. So very interesting. Yes. So we come back, we take a small break of 10 minutes, then we come back and wrap it, and we have time. So 10 minutes exactly, please, 10 minutes exactly. That is what we basically call the tax plan. Basically what we call legal means through which people basically minimize what we call the tax burden. And precisely on this topic, we are going to talk about tax planning for individuals and companies. So how do individuals tax planning? Tax planning, we'll have it as tax planning, you say for individuals, and what we call companies. So tax planning for individuals. What we are talking about allowable deductions, so now we'll synthesize. How can individuals plan for tax? That is tax planning for individuals and companies. Are we together? Allow expenses, transactions that's like set off, that is for individual. Body corporates, how do they plan for tax altogether? If you hold more than 12.5% shares in a company, the dividends from such companies are not being taxed. Are we together? That's also, a tax planning mechanism for a company. You invest in EPZs, investing in EPZs, are we together? So we'll also talk about mitigating. What do you call mitigating? We call it mitigating. We call it what we have as mitigating or defer impact of direct or defer, or we call defer impact of what we call direct, and what we basically call indirect taxation. So what we call mitigating or deferring the impact of direct and the indirect taxation. So tax avoidance and tax avoidance provision. Tax avoidance, and what we call anti-tax avoidance provisions. Section 23 and Section 24 provision. So anti-tax provision. Like for example, you're employing a family member, a minor, and you're paying them higher income in order to reduce your tax. Those are where we have what we call anti-tax avoidance. And to be precise, shortfall distribution. We'll talk about shortfall distribution. This will basically be the shortfall distribution. We have it as the shortfall distribution of what we call dividends, of what we call shortfall distribution of the dividends. We have shortfall distribution of the dividends. Then you have what we call sectoral incentives. What we call sectoral incentives. Sectoral incentives on sectors. Are we together? Disposal of business operation. Are we together? Disposal of business operation and restructuring activity. And lastly, tax risk management. How do you manage tax risk? We'll talk about tax risk management. Tax risk management. We'll talk about the tax risk management. Is that 7 okay? This is very important. This class is very important. Yes. Topic 8, tax systems and policies. We need to have tax systems, and what called policies. So this you're done on PFT. So when we talk about tax system, types of tax system, singular tax system, and unitary and multiple tax system. So we're going to talk about tax systems. And when we talk about tax systems, under the introduction to tax, I hope you remember, under the introduction to tax, those that are taught, we are going to have what's called a unitary tax system and a multiple tax system. Unitary system and what we call a multiple tax system. Then matters we talk about taxation in economic development, Role of taxation in economic development. Role of what you call taxation in what's called in economic development. Role of what we call taxation in economic development. Role of taxation in economic development. Tax-based expansion. How do you get to expand tax-based altogether? Designing what we call a tax policy. How do you get to design what we call a tax policy? Designing what we call a tax policy. Designing a tax policy. Then evaluation. How do you evaluate criteria? Evaluation of what we call a tax system. Evaluation of what you have of a tax system. Evaluation of what we call a tax system. Evaluation, tax reform and modernization of tax system. Tax, we call it reforms, and what we call modernization. Modernization of what we call of the tax system. And modernization of the tax system. That is tax policies, tax systems, and policies altogether. So we're also going to talk about large taxpayers and medium taxpayers, large tax reform, but particularly pertaining to large taxpayers and medium term taxpayers. That is topic 8. But tax systems, we discussed that under intermediate when you talk about unitary and multiple tax system together. And the last topic in advanced taxation. The last topic in advanced taxation. The last topic in the advanced taxation. We call it the last topic in advanced taxation. We call it professional practice in taxation. That is topic 9. We call it the professional practice in what's called in taxation. So we call it the professional practice in taxation. Together, team, if you now want to respond with a yes, in taxation. Together. So, under professional practice in taxation, we are going to talk about a number of things: form of tax practice and matters relating to tax practice. As you step out of here, you're going to be tax consultants and you're going to handle taxes for companies. So we are going to talk about forms of tax practice and matters related to tax practice and matters that we say relating to tax practice together. But also very important, matters relating to new clients. When you get a new client, how do you handle it? Matters, we call it the matters relating to what we call to a new client. Matters that relate to the new client. Matters relating to a new client. How do you handle new client? So then you say handling client work. Then you talk about handling of what we call of the client. How do you get to handle client's work? Handling what we call the client's work. They say moral and ethical issues in taxation. Moral and ethical issues. Moral and ethical issues to do with integrity, confidentiality, moral and ethical issues in taxations, moral and ethical issues in taxation, issues to do with integrity, confidentiality we're going to discuss, disclosures in tax return. We talk about professional disclosure in tax return, computation and correspondence with the Revenue Authority. You see, if you're a tax consultant of a company, what are you going to handle? You're also going to handle issues to do with the return. You represent companies in terms of correspondence. If Kenya Revenue Authority wants something, you do response. So we're also going to talk about those correspondence altogether. So we're also going to talk about tax agents, tax representatives, tax agents. We are going to talk about the tax agent. And we are also going to differentiate between tax agent and tax representative. So tax agents are together. The appointment, how do we appoint them? What is the obligation and what is the professional liability? Cancellation of tax agent license. Cancellation cancellation of tax agent license. So what leads to cancellation of tax agent license altogether? Role of tax agents in appeal. When you're appealing to tax, what is the role of tax agents in appealing? In appeals procedure. Then lastly, something that I always do, tax health check. Companies need to do what we call a tax health check. We ignore this. Many people health check. You start a business is thriving, but then you do not put taxes in order. What is likely to happen, Kapuru? You start a very fruitful business, but then you forgot just to touch on one part, and that is the tax. Do you think this can really crumble your empire if you don't check on your taxes properly? It can bring your empire crumbling. Is that true? Is that true, Kaburu, Joy, and Liz? Perfect. So that marks the end of what we call the course of a number of things in this class. As a summary, how we are going to approach this unit. What I want to say in my classes, that all that you do is by the grace of God. I know that by the grace of God, this unit is going to be very simple. As long as we follow instruction, Joy and the team, as long as you follow Mwalimu's instruction. Number one, we put God first. Number two, we follow Mwalimu's instruction. And number three, we commit to the journey. I should have everybody passing. Is that true, Joy? Is that true, Kaburu? Is that true, Maina? Is that true, Liz? Number one, we put God at the top. Number two, we make sure that we follow the instruction and we commit to this journey. This unit, we should be able to pass it. And everybody, we should have 100% pass. When you tell students 100% pass, it sounds crazy, but it's possible. I know, 100% pass. I know, it's possible because I'll be teaching you tricks. As you work on this, I also teach you tricks to basically pass advanced tax. You don't need to be perfect. You don't need to be perfect like Mwalimu in order for you to pass. So those are the tricks. So the first thing that I wanted to do, I needed to have a representative class rep. And somebody just to volunteer class rep. I don't want to choose for somebody to volunteer as a class rep. Who is going to volunteer as a class rep for this class? Class rep. Who is going to volunteer? Who is going to volunteer as a class rep? Who is going to volunteer as a class rep? Just somebody just to volunteer. Joy, Kaburu, Liz, Maina, who is going to volunteer as a class rep? And if you're joining us because this one class was free, purpose to join and share with your friends too. Who is going to volunteer as a class rep? Who is going to volunteer as a class rep? Who is going to volunteer? Joy will be our class rep. Perfect. So Joy, all communications will work with you. Yes, we'll work with Joy to make sure that this class works. It's very important, class representative. Yes, very important to work with the representative. Making sure that you encourage the class. One of the things is a leader helps make the work easier for Mwalimu. If you have the class rep, all communications, if you need to do something, we can always organize with our class rep. But again, I'll start with what you call the basics. When I start this class, these are very important. Some people took tax before. I went to the basics. You realize that the two classes that I'm going to have, the Sunday and Tuesday, they will be on basics. I'll teach you, look out, if I don't teach you in this, you will not be able to work on this. Capital allowances, capital, we'll talk about allowable and non-allowable capital allowances or investment allowances. These are basics. We have to go. Allowable and non-allowable expenses, taxable and non-taxable income. So when you look at the first two classes, Maina, they will be on basics. I'll go back to the basics of taxation. Because somebody did tax, for example, somebody has stayed outside maybe for 3, or somebody did tax maybe intermediate 3 or 4 years ago. You cannot start on this. When I start telling you allowable and non-allowable, we'll start with the basics. So this basics should take us about 2 sessions. This basics, I call it basics and investment allowance, allowable and non-allowable expense, altogether, dividends, income, incomplete records. This should take us about 1 to 2 classes. I'll teach you the basics before we start on the partnership. Is that okay, Joy? I'll go back to the basics because some people, they did tax some time back. And if I start this without teaching the basics, so I'll teach basics of taxation in about 2 classes. Once I teach those basics, everything should flow. Is that okay? So that is the basics that I'm going to teach. So then, the next thing, there's no writing notes in this class. We have what we call handouts. We have the handouts. So there's no writing notes in this class. Simply work with handouts altogether. I give you the handout. From the handouts, you can make your small notes. There's some things that I could be mentioning, you can add them. But we'll simply work with handouts. Nobody is going to write notes. Is that okay? Nobody is going to write notes. So in our next class, that is on Sunday, I'll start the basics before I start on partnership. So I'll spend maybe a class or 2 on the basics. Once we do those basics, we now light the fire, and we have started. Let's move away from the modes of results. If you've gotten your results, let's now get to work. We don't celebrate for long, but now we focus on work. Sometimes when you celebrate for long, we have started the journey. Yes. Where we do not do well, we reflect, but now we start on the journey. I want to say that I am so blessed to be given an opportunity by God to serve you, to be your lecturer for advanced taxation. I promise that I'll do my best. For those who have met me, I'll do my best to make sure that everybody passes. And I would love you people to commit. Talk about focus. Share about focus altogether. Share about focus. Tell your friends about focus. If you're gaining something in focus, then you let your friends know. You share with them. Tell them join focus. If you enjoy something in advanced taxation, tell somebody about advanced taxation. But not only about advanced taxation, you can tell them about economics, FA, all other classes that we have. And I know we shall make in this journey. Don't worry. Everything, as my parting shot, everything is going to be all right. As we unfold the pages of this advanced taxation, everything will get clear. And each day as we unfold these pages, it gets better and better. And be assured with God on our side, we shall be able to make it. I want to say that God bless you and God bless our class. Our class is ended today. Unless somebody has something that is burning that you'd love Mwalimu to maybe clarify. But I beg to stop at that point. God bless you all. Liz, do you have something? Kaburu, do you have something? Joy, do you have something? Maina, do you have something? Thank you so much too. God bless you. We can wrap it there for today. We'll meet on Sunday at 2 p.m. On Sunday at 2 p.m. That's our meeting point. Thank you. We can close it there.